All right, today we're going to talk about a really powerful and, let's be honest, often misunderstood tax strategy for anyone who owns property. If you've ever looked at your tax bill, then looked at the paper losses from your rentals and just felt frustrated, well, you are in exactly the right place. Let's get into it.
So, simple question first. Do you own rental property? If the answer is yes, then you're definitely going to want to stick around. You might be sitting on a tax break that could literally save you thousands of dollars. But, and it's a big but, there is a catch.
And here's the problem, the core issue, right? Your rental properties, especially when you factor in huge deductions like depreciation, they often generate some pretty significant losses on paper. But for most people, those valuable deductions are totally locked away, completely useless against the income from your main job.
So why? Why are they trapped? Well, it all comes down to something the IRS calls the passive loss rules. Let's break down what that actually means.
You see, the IRS has a default setting for rental property. They automatically consider it passive. They just assume you aren't deeply, materially involved in it day to day, even if it feels like you're working a second job. And that one little word, passive, is the lock on the cage holding your deductions.
So here's what that passive label really means for your wallet. Your rental losses are stuck in their own little bucket. Sure, they can offset profits from your other rentals, but they cannot cross that wall to reduce the tax you owe on your W-2 job, your spouse's salary, or your main business income. They're just trapped over there.
But what if you could change that default setting? What if you could just tell the IRS, nope, not for me? Well, you can. The key is an official IRS designation called Real Estate Professional Status, or REP status for short. And this is how you turn those abstract paper losses into actual real-world tax saving.
So the whole point is this. Rep status is an official recategorization. It's you telling the IRS, hey, listen, real estate isn't just some passive hobby for me. It's a serious, significant part of what I do. And by proving that, you get to play by a whole different set of rules.
And this is the difference it makes. Look at this. In the default scenario on the left, your losses are trapped. But with rep status, on the right, you get the key. Those losses are unlocked. So imagine, you have a $20,000 paper loss from your rentals and $100,000 in W-2 income. Without rep status, you're taxed on the full $100,000. With it, you're taxed on just $80,000. That is the kind of power we're talking about here.
So what does this power look like in the real world? It means you can use your rental paper losses to shrink the tax bill from your high-income day job. It means one spouse's real estate work can actually offset the other spouse's W-2 income. And suddenly, that depreciation deduction becomes this incredible tool that saves you real money this year, instead of being just a number trapped on a form until you sell.
Okay, so this sounds amazing, right? But it is definitely not automatic. To get this RAP status, you have to pass two very specific tests from the IRS. And let me be clear, you have to meet both of them. They are completely non-negotiable, no wiggle room.
So what are these two hurdles? First, we have the time test, which is all about how much time you're spending. And second, there's the material participation test, which is about how you're spending that time on your own rentals. Let's tackle that time test first.
Now, the first part of this time test is the big one. More than half, so over 50%, of all the time you spend working during the entire year has to be in real estate. This is why if you have a really demanding full-time job as, say, a doctor or a lawyer, this test right here is often the hardest one to pass. And the second part is just a hard number. You have to spend a minimum of 750 hours per year on those real estate activities. That breaks down to about 15 hours a week, every single week of the year. And you have to meet both the 50% rule and this 750-hour rule. It's not one or the other.
So what kind of work actually counts toward those 750 hours? Well, we're talking about active work. Things like being a real estate agent, developing property, managing your rentals, finding tenants, overseeing repairs and renovations. This isn't about sitting back and just passively collecting a rent check. It's about being actively involved in a real estate trade or business.
Okay, so let's say you've cleared the time test. Fantastic. But we're not done yet. There is a second hurdle, material participation. And this test zooms in specifically on how involved you are with the rental properties that you personally own.
You've got a few ways you can prove this. The most straightforward is spending over 500 hours a year just on your own rentals. Another way is to prove that you do more work on them than any other single person. Yep, even a property manager you hired.
But for a lot of investors, the real key is a powerful strategy: officially grouping all your rentals into a single activity for tax purposes. That makes it way easier to hit these hour requirements.
All right, now we have to talk about something that is absolutely critical. If you're going to claim rep status, you have to be ready to prove it. And that brings us to the all-important paper trail. And let's be crystal clear about this. Real estate professional status is a frequently audited item. The IRS scrutinizes these claims very, very closely because the tax benefit is so huge. You cannot just wing it. You need proof, cold, hard proof. So what does that proof look like? It looks like this: a detailed, organized, and, most importantly, a contemporaneous time log. You need to be tracking the date, which property, the specific task, and how much time you spent. In an audit, this document right here is your single best defense. It's your shield.
And the key word here is contemporaneous. It's a fancy word that just means you track your time as you go. Weekly is probably best. Trying to reconstruct a year's worth of activities from memory right before an audit is a massive red flag. And frankly, it's how a lot of people lose this argument with the IRS. And you've got to back it all up with proof: emails, contracts, invoices, anything that shows you are actually doing the work.
Okay, so we've covered the what, the why, and the how. Now it's time for a quick reality check. We need to figure out if this powerful strategy is actually a realistic fit for you and your specific situation.
It really comes down to 3 honest questions you have to ask yourself. First, is real estate your primary profession or your spouse's? So you can meet that 50% time test. Second, do you actually own the rental properties that are going to generate these valuable losses? And finally, maybe most importantly, are you willing to do the work, both managing the properties and meticulously documenting your time? If you can say a big yes to all 3, this could be a game changer for you.
Now, one last thing. There's a really important nuance here with short-term rentals. If your average guest stay is less than 7 days, the IRS might consider that an active business by default, not a passive rental activity. And if that's the case, you might not even need to qualify for rep status to deduct your losses. For your traditional long-term rentals, however, rep status is absolutely required to unlock those losses. It's a huge distinction.
So we'll end with this one question, because it really gets to the heart of the whole matter. The IRS wants to know, are you just a passive investor who happens to own property, or are you an active, documented real estate professional? The answer to that question, proven with your time and your records, could make all the difference in the world to your tax bill.
Looking to buying a home in Columbia, Missouri? Call Blue Spruce Realty today.